Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will have a very practical topic. We will discuss what is the movement of the cryptocurrencies around some specific events, and those events will be public holidays. The whole video is based on our article. It's called Surprisingly Profitable Pre-Holiday Drift Signal for Bitcoin. I mean, as the title of the article shows up, it will be about the profitable trading strategy. It is one of the articles that describes the crypto trading strategy. We have quite a lot of them in our database. At the moment it's more than 60, so they consist of approximately 5% of the whole Quantpedia database. And the article is based about the drift around the public holiday. This is not the first effect or first anomaly that's connected to public holidays. Probably a year ago we wrote an article, Pre-Holiday Effect in Commodities, in which we explored that there is a significant drift in the price of gasoline and oil close to holidays. The reason for that is simply because people like to travel. For the traveling, they need to buy gasoline because they usually travel by car.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
This demand for the gasoline means that there is a short time drift or short drift in the price of the gasoline a few days before the public holidays in the US. Very similar effect is related to the cryptocurrencies. What is the fundamental reason behind that? So usually people are bored over the public holidays. They tend to be at home. They have more time to follow the news. As the cryptocurrency market is driven by retail speculation, those people usually speculate more. We firstly try to download the data. What are our data? We are using the data from the regulated exchanges. So we are using the data about the Bitcoin futures. Bitcoin futures from 2018 until 2021, and then from 2021 until 2025 use the BYTO ETF. But we are using the Bitcoin futures and Bitcoin futures ETF and not spot ETFs. Firstly, the spot ETFs were introduced this year. They have a very short history, while on the other hand, the Bitcoin futures have a longer history. They are closed over the weekend when there are public holidays, and this is not disadvantage, this is actually advantage, because we are trying to trade around the holiday, we are trying to catch the drift. It's simpler to do on the public markets, and also we would like to build a trading strategy that is available also for somebody who is heavily regulated and cannot trade spot Bitcoin on unregulated crypto exchanges. So this is the reason why we picked this underlying. And then we downloaded the data about the public holiday dates defined by the consensus US calendar from Time and Date website. That was simple. Here is the public holiday window analysis. So the day D0 is the day when the stock exchange is closed. When the public holiday is mixed together with the weekend, the D0 is also the public holiday plus the weekend. And D-1 until D-5 are 5 days before the holidays, and D+1 until D+5 are the days after the holiday. Okay, so this is how does it look like. You can see that we have only a small drift 1 day after and 1 day before the holiday on average, and here is the equity curve. As we can see, this is not very attractive. The equity curve is highly volatile. But what is the idea is that we would like to couple or combine this strategy with another, and it's a 10-day high strategy. Why is so? If during this period the crypto prices are already breaking to new short-term highs, this is the higher attention that the crypto market will get at this moment, plus the boredom of the retail, which has nothing to do around the public holidays, can cause the price to go even higher. So we can have a higher probability of prices going higher if there is not just the holidays, but if there is a strong price drift close to the holidays. So we are making a new short-term high. It can be 5, 10 or 20 days. So here we have a chart. Keep in mind that this is the combination. How does it look like around the public holiday when the price is reaching the new short-term high? And here we can see that this chart looks significantly different from the chart that I showed you before. From D-5 until D+1, we have significantly positive performance each day. Each day before the holiday, if the price is making new short-term high, there is a strong probability that the next day the price will once again make a short-term high and we will have the positive performance. And it doesn't matter whether we define the short-term high by a 5-day high filter or a 10-day high or 20-day high. So there is still a strong drift. The 5-day high is the best one, so the short-term highs are better than the longer term highs, but here we have an equity curve and we can see that the strategy works well also for 5 to 10 to 20-day high filter. So what is the performance? So here we have a performance. So for example, if you use the 5-day high filter, once again we buy the crypto for 1 day, for 1 trading day, so not 1 calendar day but 1 trading day. If the crypto or Bitcoin is making new high and we are close to the public holiday, so we are in a range between D-5 until D+1 around the public holidays, we have a performance around 38% with a low volatility, Sharpe ratio over 2, Maximal drawdown was lower than 10%. So I mean, absolutely great risk to return numbers. We can confirm that Bitcoin exhibits a pre-holiday drift. It's very similar to the drift observed in equity markets, and also is very similar to the drift that is happening in commodity markets. So not just equity, but also in commodity markets, but only when pre-holiday effect is coupled with the short-term momentum trigger. So I mean, the end day high filter serves as a proxy for heightened market attention, and it captures instances in which retail and institutional participants simultaneously face discretionary trading time and positive feedback loops. So we can see that if we combine those two triggers together, we will have a very interesting performance. So I hope that you like this idea. I hope that you like this article. It's a very simple one, but on the other hand, surprisingly profitable. If you would like to read more about the cryptocurrency trading, more trading strategies, feel free to look out into our database. We have over 60 trading strategies related to the crypto markets. In the description of the video, there will be more articles that you can read about, and I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.